Welcome to the Daily Update. Well, I'll go over the action in the market for Friday, November 24th, and then we'll see how things look for Monday, November 27th. And this is take two for this video. I recorded this a number of hours ago, and it was probably the best video ever made in history. But for some reason, between having trouble getting the information from stockcharts.com, which made me late in the first place, when I got done recording this, Zoom said, sorry, we didn't record this for you. You're going to have to do it again. So here we are with another take. And this is also meaning that I'm posting this a lot later than I usually post the daily video over the weekend. After this, I will be doing the weekly video, the intermarket analysis video, as well as the deep dive video. So let's go back and talk about how things happened on Friday. Right at the open, it was the boring of boring days. If you think some of the last few days over the last week and a half or so have been boring, my goodness, if you tried to stay awake on Friday, you probably had a really hard time doing that. We had a flat open and prices chopped a little bit above and a little bit below the unchanged level. And then, just to make it even more uninteresting, prices stayed flat and then closed a little bit higher. So we really didn't go anywhere in Friday's session. Now, some people might say, well, why do they even have the market open on Friday? That's because all known information is immediately put into the prices of stocks. And as something happens, whether it's news about a company, news about the economy, news about what's happening across the world, it gets baked into the market immediately. And the more it's open, the more we can look at current prices and go, okay, every known thing right now is in the price. So that's why they don't like to keep the markets closed for very long. And even there are some days during the year, like this day, between Christmas and New Year's is often very slow. Sometimes in the summer, it can get really slow as people are going on vacation. And so what'll happen is it's like, why are we even doing this? Well, it's just in case somebody wants to buy or sell based on what they feel. Our price is going to go up or our price is going to go down. But Friday was definitely one of those days. We were up 0.06%, pretty much unchanged. Volume was way below average because we continue to be in holiday mode. We should pick up after this weekend, but we never know that for sure. We can only think that that's what will happen. But typically after a holiday, people are coming back and they may decide to buy or sell. And so we might see a real pickup in volume. We are positive in the short and intermediate and long term, but there are some warning signs, and I'll go through some of those charts. We are overextended in the short and intermediate term. There's even a few long-term indicators that we look at that we just want to know about these. It doesn't necessarily mean things are changing. We just pay attention to this day by day to see incremental little changes. And then as those changes either go away and we can forget about them or they start to grow, then that helps us to make decisions. Okay. And I'm also recording this after lecturing for the last 7 hours, so my voice is pretty much gone. But the market is still really fixated on inflation, interest rates, growth concerns, what's happening in Israel, earnings as they are released, and anything else that can come flying into the picture. So what are some comments? This was one thing that's kind of encouraging. What we've been seeing over the last few trading sessions is the broad market starting to pick up and do a little bit better. Now, are we going to see some follow through? Are we going to see the small caps do better, the mid caps do better? They have been improving, but they've improved before only to stop and turn around and start to go back down. So we're keeping an eye on that. We're seeing some more broad participation, even within the S&P. Even though the mega caps make up most of the S&P's movement, there are still over 500 stocks that make up the S&P. And when those stocks start to really go up, that helps the index itself. Oil did close down at $75.54. And here's our short-term list where you could say we're overbought or we're extended to the upside. We have the VIX based on 9 periods. So that's just suggesting that maybe we've gone up a little too far too fast because the VIX is really dropping. The short-term advanced decline ratio, that's a new addition to the list. The 20-period exponential moving average, the Stochk RSI, Williams percent R. The CCI 14's actually dropped off, where the CCI 20 is still on the list. The stochastics, all three charts are that way. We have the RSI, which is our short-term RSI based on 9 periods. The boom indicator, we're still getting far away from that 20-period exponential moving average. And then the slope oscillator is actually starting to roll over a little bit after giving us an extreme reading. Intermediate term, we also have a pretty long list. We have the CMB composite, which has been camped out extreme for about the last week. The PMO studies, the rate of change going back 20 periods. The RSI 14, which is more intermediate term. The Sean trend meter, the TTM squeeze, the McClellan oscillator for the S&P, the bullish percent index for the NASDAQ 100, and that's starting to roll over a little bit. That's another warning sign. The new highs, new lows studies based on 10 periods for the S&P 500, the advanced decline ratio based on 19 periods, and I'll show you that chart, and that's just based on price. We're not seeing it based on volume yet. We're still going with this same basic scenario. The market is okay for right now with where the economy is. As long as we don't get too hot or too cold. If we start to get really hot, then they're going to freak out that the Fed's going to come in and raise rates. If we get too weak, then they're worried about, uh-oh, this is deflationary and we're going to lose the economic growth that we've been experiencing. So we'll freak out about that. And this could change at any time. But for right now, the market kind of likes where things are at. So the Fed is continuing on with this idea of keeping rates higher for longer. Now, the market tries to introduce its own scenario, and that's the way it really should be. The Fed should follow the market. It's not necessarily the market following the Fed, but it doesn't always work out that way. So as we saw back in 2022, the market likes to develop these scenarios, even if they're unrealistic, that maybe the Fed's done raising rates, so we can buy now. Maybe the Fed's going to cut rates, so we can buy now. Oh, no, Jerome Powell came out and said something that got in the way of that. Now we're going to sell. And that's where we saw a lot of the choppiness in 2022. We have to keep our eyes open for that to happen even at the current time. We also need to keep an eye on what's happening in Israel. We also watch oil to see if it starts freaking out the market or if it's becoming more irrelevant to what's happening day in and day out. And then earnings as they are released. The dollar was down and interest rates were up in Friday's session. We still have the 10 to the 5, the 10 to the 2, and the 10 to the 3 month, which have their yield curves still inverted. Sentiment is still positive at 68. We ticked up from 66. We can still go with this for right now. We're not getting extreme yet. While we're going more positive, we can roll with it. We can ride that wave. But then when it gets too exuberant, then that's when we start looking at things going in the other direction. Our trend is still positive. The green line's on top, even though that green line's getting kind of extreme. The ADX is above its moving average. That suggests that we are in a strengthening trending environment, and they're both above 20. Our bias is positive and our momentum is positive. Bias is one day, that was Friday, even though it was a sleeper. The momentum is the last 2, 3, 4, 5 trading days kind of taken together. So the economic reports, and I don't have charts. These I'm just going to go through these really quick. The preliminary reading for S&P Global U.S. manufacturing, that's the key word, manufacturing. It came in a little bit under 50. That shows slight contraction. When we're above 50, that shows growth. It came in at 49.4. Last time it was right at 50. And then we had the services number come out, and it's just a little above 50 at 50.8, where last time it was at 50.6. We are keeping an eye on the 10-year yield. It is now at 4.47%. That's above the 4.02% because, according to Red and Mac research, when we get above that level, that's when it starts biting into corporate profits. Here's the intraday chart, which is a real sleeper here. We had a flat open and just stayed flat. Little bumps up and down, but for the most part, my gosh, we almost closed at the high for the day. Can you imagine that? Real sleepy day. When we look at the intraday chart, we were more positive before the market actually opened. And then as we came into the opening, we ended up being flat. And then as the futures wound down for the weekend, they were a bit more positive. We'll have to see where they open Sunday afternoon or evening. We did see value outperform growth. The red line was positive where the blue line was negative. That's a little bit of a warning sign, but on such a low volume day, we just kind of have to take it for what it is. We did see the ratio go down when we look at S&P growth to value on an intraday chart. That's a little bit of a warning sign. It had been showing some improvement, and now we're seeing some weakness here. We want to follow this. In a good, strong environment, we want to see this really going up the way it was earlier in November. Some end of day charts where growth was down when we look at large cap growth, where large cap value was actually up. For the mid caps, growth also underperformed, but for the small caps, growth actually outperformed value. That's a little bit positive. And when we look at the growth to value ratio for the small caps, it's holding up fairly well. We're still range bound here overall, but it's not falling apart, especially as the index was coming down. We were going sideways here. That could be longer term positive. And we're seeing kind of that same thing with the mid caps. This ratio continues to hold up, even as the index was under pressure. We're not really seeing a breakdown in the growth to value ratio, but we're not really seeing any strength here when we look at the S&P growth to value ratio. It did decline in Friday's session, but we're still chopping sideways, although the blue line is above the red line, so we are in an uptrend. We are still looking okay here when we look at this other growth to value ratio. It turned down just a little bit, but it's still breaking out from above these previous highs. When we look at the trend, this is the green line. This is getting near that 40 level. And that's when we get a little bit concerned, because other times when you see the green line really spiking up here, a lot of times that marked at least a slowdown, if not some kind of a pullback. Well, we didn't quite get above this on the intermediate term chart, but we are kind of extreme. However, we still go with the positive for right now. And this is a strengthening trend because the ADX is above its moving average. In the short term, we did get a little bit above 40, and now we're coming back down, but the green line's still on top. So that's positive, and the ADX is above its moving average and advancing. So that is positive and a strengthening trend. But we're really dropping off with volume, which is not necessarily surprising around a holiday. Looking at sentiment, I dropped this circle down here a little bit. We're coming into the latter part of November, beginning of December, where sometimes we get a little bounciness at the beginning of the month. The Ulcer Index is suggesting that there's really no fear in the market. When the market's going down, that's when this indicator goes up. And now that we're really dropping, it's just showing that we've been going up with price. And the VIX is really dropping based on the line chart. We're actually starting to drop below these previous lows that we saw not so long ago. And the bar chart is also starting to drop down. The volatility of the VIX did tick down just a little bit with the line chart, and we're pretty much sideways to a little bit higher with the bar chart. And here's the movement, or how fast is the VIX moving. We are starting to get an extreme negative reading. That's because the VIX has been going down as stocks have been going up. And then the VIX to VVIX ratio, this is going down, which this could be positive. If you notice other times when we were really going down with this ratio, look at what the S&P was doing at that time. It doesn't mean it goes straight up, but it sure has a positive bias. And if this can continue to decline, that would be positive. Also, we're declining with this ratio when we look at the VIX to 3-month average of the VIX. Other times when this was dropping, that often gave really good support to the S&P. The VIX to move ratio is also declining, meaning that stocks are less volatile than bonds. And the equity put call ratio, this is a little bit of a concern. Now, some of this might be explained by the holiday weekend. Folks want to hedge themselves. There's a lot of geopolitical unrest right now, and they don't want to get caught where they're unhedged with some of their long positions. And so they might have went in and bought some puts on Friday. Well, that's why this spiked up on the daily chart. And the 5 period, which we pay more attention to, it's now starting to go back up. We were getting some more confidence in the market when this spiked and started to come down. And that helps us to feel kind of good. But now we're starting to go back up. Now, we did come down quite a bit, and we might have actually got to an extreme reading, but we haven't got there yet. Now, we'll have to see. After Monday's session, is this going to change if there's nothing major that happens over the weekend? And then we'll see this ratio start to go back down. That's what we're waiting to see will happen or not. The longer term 253 period equity put call ratio is turning down now. If this can really start to turn and keep going down, that would be longer term positive for the market. And you can compare other times what was happening when this was going up or down. We look at this fear gauge where it ticked up just a little bit, but overall it's been declining. Here's another fear gauge, which also continues to decline. We're looking at the risk on to risk off ratio. This isn't as strong as we would like it. We've been declining in the longer term. We have been seeing a bit of a bounce here, but then we declined a bit on Friday. We want to see this ratio really going up, meaning that folks are preferring to buy stocks. We did get the latest reading of the American Association of Individual Investors. They're more positive. Remember, they react to what's already happened, and we're starting to see the bounce up be reflected in how they're feeling, but they're not necessarily extreme right now. If we have another up week and they get up into this area, that's the point at which we would start to look at this as a contrary indicator. Folks are just getting too complacent. They're getting too positive on the market. And quite often that's when the market will turn, but we're not quite there yet with this reading. The advanced decline line, we're still showing some improvement based on price and volume and above the moving average. We are not necessarily seeing a breakout of new highs, but we are not seeing any new lows. And so that's helping our 5 period and our 10 period to go higher. This is one of the extreme readings. The blue line, which is the short-term advanced decline ratio, that's starting to get to a pretty high reading. And sometimes you can see it didn't necessarily mean we turned around, but often it could mean that we stalled out at that point. Accumulation distribution. This is measuring, is the smart money buying? And it looks like, yes, they are continuing to buy for right now. Also, another smart money indicator, the chicken money flow, continues to show some improvement, suggesting the smart money is buying. We are seeing some improvement with the cumulative advanced decline line for the NYSE. This is a broader measure, but we have not been able to get back up to this trend line yet. We are showing some improvement with our regular advanced decline line. That's breaking out above the trend line. And here we're coming above both of the moving averages with the advanced decline line, but we're still working off of a recent death cross here. And then I updated this as well, where I had been pointing this out that we were starting to see a breakout based on volume with the NYSE, but we were not seeing that confirmed by price. Now it's being confirmed by price. So now we have more of a breakout that we have more confidence in, that things are getting a little bit stronger. Okay, just want to make sure. So looking at our advanced decline line studies, we're showing some improvement with the NYSE common stock, the S&P, the mid caps, and the small caps for the first time in quite a while are starting to break above the moving average. But this is a declining moving average. We need to stay above this for some time to turn that blue line and have it go back up. Our short-term charts, we're still hanging in there. And this is actually looking kind of healthy right now. When you look at this all together, we're seeing a series of higher highs and lower highs. Higher highs and higher lows. That's what I meant to say. Now, this could change at any time when volume comes back in. We can only go with what we're seeing right now. And this is showing some improvement. And we're still above this pivot point. But on the bottom, you see where volume really dropped off. Not only were most people gone, but then it was a shortened day as well. But when we look at our 20-period exponential moving average, we're getting extreme. We're still positive with the 50 and turning back up with the 200. Then our short-term indicators, the Stochk RSI is extreme positive, as is the Williams percent R. The CCI 14 is gone, but the CCI 20, even though it's declining, it's still above 100. That's extreme positive. The force index is not extreme. It's well away from the Keltner band. It's above the midpoint, even though it has been declining. But the stochastics on all different time frames, short, intermediate, and long term, we are extreme positive with all three. We're also well above the +3 Keltner band here, looking at our standard deviations chart. This still is suggesting that we've gone up a little too far, too fast. Then looking at the boom indicator, when we're above this line, that means we're getting far away from the 20-period moving average. Down here where the 50 and 200 are, we are showing them going up. So that's positive until they get up to an extreme reading, and they're not there yet. Our intermediate term charts, the balance of power after being extreme has now given us an overbought signal and is starting to come back down. The CMB composite continues to be extreme positive and has been for about a week. The go-no-go system has dark blue bars. That's positive. We're at the upper end of the highest high value, and that's continuing to go up as the midpoint is also going up. The TTM squeeze, another potential warning sign. We were starting to get a pretty extreme reading. This is the light blue bars that you're seeing. It's now changed over to a dark blue bar. So that's kind of a warning sign. You can see other times we were going up and then it turned to dark blue and we went down. We were light blue, dark blue, down. So we want to see if something like that's going to happen here. Here's a longer term look at that same chart where the last time we had a really high reading, this ended up marking a top in the market. Now, I'm not going to say that that is what will happen this time, but we just want to be aware of this and know that this is happening right now. The rate of change going back 20 periods is continuing to be extreme positive. And then other times, like back here, we had an extreme positive reading, but then the market pretty much went sideways before it started declining. The ease of movement, and some of this might have to do with how the indicator is actually calculated. This only goes back 14 periods. Well, every day, a new 14 is added where the very first value is taken off. And so these numbers get higher and higher and higher as the indicators recalculated, and it can't help but start to roll over. And that's the way moving averages work. Bollinger Bands work that way. A lot of our trend-based indicators that use historical price data, that's how they work. Our momentum oscillators are like that too. But this can also be a self-fulfilling prophecy when we see a lot of these happening at the same time. So even though this is positive, it is starting to roll over. The Arun indicator is still positive. We're above the zero line with the oscillator. The green line's on top and the red line's on bottom. That means buyers are in control. We're starting to get extreme with the McClellan oscillator for the S&P 500. Now we could go up higher than this, but we're just above this level where we like to really keep an eye on it. However, when we look at the summation index based on price and volume, we are still positive. The summation index for the NYSE based on price and volume is also positive. The Swenlin trading oscillator based on price and volume are turning back up. That's positive. The PMO is suggesting that momentum is positive, both based on price and volume. When we look at our PMO studies, we're extreme with the PMOs that are rising. We're extreme with the buy signals, and we're still positive with the PMOs that are above zero. However, even with the up days that we've been seeing, for our Elder Impulse system here, it's still blue. That's neutral. And you're going to see that across other indexes as well. The parabolic SAR, though, is still positive with the dots underneath. The slope is starting to roll over. Again, part of that could be the number of periods that are used to calculate this, and that's causing this to roll over. But also, we're getting a pretty extreme reading now. However, the MACD is still chugging along and looking positive. That's more intermediate term. And here's a long-term weekly chart of the MACD. We did close above this moving average. This is turning the long-term momentum back more positive now. So when we look at all of our oscillators, we're rolling over with the slope, but our other short-term oscillator, the TSI, it's not rolling over yet. So we're not really seeing a confirmation here. The MACD, the PMO, and the PPO continue to be going up, and our long-term oscillators, the TRIX and KST, continue to be positive. The Sean trend meter, when it goes above this red line, that's when we're starting to get extreme. It could still go higher than this, but this is where we want to really keep an eye on it. We're above all the moving averages in our moving average tree. The longer we stay up here, the more these lines will continue to turn back up. Bullish percent index. This has been positive now, even on down and slow days. We're seeing this chug higher. It's above 50 and advancing and not extreme yet. That's suggesting there's more internal strength in the S&P. We're just barely crossing above 50 with the NYSE bullish percent index. So this is looking at the broader market, and this is turning more positive. However, when you look at the NASDAQ 100 bullish percent index, this has gone extreme and is now starting to roll over. If it drops below this line, that's going to be a sell signal. So that's one thing to be aware of. And these are the big mega cap stocks, which are also included in the S&P 500. Chicken oscillator did tick down, but it's still above zero. The money flow has generated an overbought signal now. It came up and now crossed back down. And we also are working off of a recent overbought signal with the ultimate oscillator. The vortex, after getting extreme, is coming down, even though the green line is still on top. The RSI 14 is just barely extreme, where the RSI 9 is more extreme. On balance volume continues to look positive and is above an advancing moving average. We showed some improvement with the 250-day moving averages when we look inside of the S&P 500. The copy curve is rolling over, but is still positive. And here's a longer look where we had some kind of high readings, and then you can go back and look what happened after that. Are we going to tank after this? There are times when we got a high reading, and then it really didn't lead to much. There are other times when we got a high reading, and it marked a reversal. The Pring bottom fisher, which we had more of a legitimate signal back in October, but that didn't really help us. We had more of a weak signal here, and that turned out to be a pretty strong signal. I don't have any Fibonacci charts. The only thing I can say here with our trendline study, we're just a little bit above this previous high. And so right now we're breaking out above resistance. Can that hold? Our different charts, we are positive across the board based on trend. The Heiken Ashi is positive, the Kegi, the Renko, and the three-line break. They are all positive. Our long-term chart, we are above this trend line going back to 2009, and we're getting comfortably more above that right now. But this is another warning sign, the Zohorchak method. This doesn't generate very many signals. For a lot of 2023, we had a buy signal. Then when we hit the skids back in summer, in August and September, that got kicked down to a 4, and now we're down here to a -6. If we go down here to -10, that's a sell signal. Now, it could still rebound from here if prices turn and go back up, but the fact that this is showing longer-term weakness does make us a little uneasy. Some indexes, we are seeing some improvement with the equal weight. That's the red line, but it's still underperforming the S&P 500, the weighted index. And this ratio is bouncing around a little bit, but when you look at the longer term, this is continuing to go up, meaning that the mega caps are outperforming the rest of the market. We were up with the Dow, the transports, and even the utilities were up slightly on Friday, but the transports continue to underperform the Dow. We're seeing this ratio actually kind of chopping around. We want this ratio to really go down. That would mean that the transports are outperforming the Dow, and that usually produces a more healthy environment. Here's another look. The transports are not really moving when compared to the S&P. We want to see this ratio going up, meaning that the transports are outperforming the S&P. Other times when that happened, you can see what chart action followed after that. The Dow is still looking okay. It's still above this pivot line. We had a death cross for about, 45 minutes or something, and now we've been able to come back above that, and we're generating a golden cross again. But when you look at the Elder's Impulse system, the diamonds still remain neutral. The NASDAQ is also still above this pivot point, and we're back to dealing with this previous high now. And we're still above the 61.8% retracement level. Are we going to break out above this, or are these previous prices going to end up providing resistance? The NASDAQ 100 is still above this pivot point. We're coming back, and we're a little bit above this previous high. Can we stay up here and then continue to go, and then maybe give a shot at creating a new all-time high? But when you look at the Elder's Impulse system, we are still neutral with blue bars. On a momentum basis, we're rolling over just a little bit with the PPO, but the NASDAQ 100 continues to be positive. The small caps are showing some improvement, but they're still not above their 200-day moving average. And here we look at the Russell 2000 small caps. We're above 50 and going up with the RSI, but we have a recent death cross. So the longer-term trend is negative. Shorter-term trend is showing that we are positive. So we're getting some mixed signals there. And we continue to be neutral with the Elder's Impulse system for the small caps. The mid caps are still above their 200-day moving average. So that is showing that support is holding. But the mid caps remain neutral for the Elder's Impulse system. The financial sector is still above both its 50 and 200-day moving averages, and now we're starting to generate a golden cross. The micro caps are above 100 and showing some improvement. The FANG index was flat to slightly down, but we've been seeing a really healthy move up here. We're above the 50-day moving average, and we're in a longer-term uptrend. Are we going back and testing this previous high right here? Are we going to be able to break out and create a new high, which you see a little more pronounced? We did set a new intraday high here, but we are not there yet on a closing basis. Is that going to be a problem, or are we going to be able to break through that? The dollar continues to be in an uptrend, even though it didn't really have a very good week. Looking at interest rates, we were up with the 10-year yield. We were down with 10-year based on price. Then this is also, it might be because of the weekend. When you take the 1-month yield and subtract the 3-month yield, we're getting a positive result of 0.01. We should always get a negative result because the 3-month is further out than the 1 month. Sometimes this gets out of whack when the market gets a little out of whack. We'll keep an eye on this. An update of some of our possible positive scenarios. We're still above the moving average when we look at the Qs to S&P. We're pretty much on the moving average with discretionary to the S&P. Large cap growth is still above the moving average when compared to large cap value. And when we look at growth to value ratios for the large cap, mid caps, and small caps, we're still hanging in there. We're not showing an awful lot of strength, but we're not really seeing an awful lot of weakness right now. This is the other new indicator that made our list. This is the 10-day average of the S&P 500 highs minus the lows. We're starting to get extreme. There are two ways you can look at this. We're overextended to the upside and due for a pullback, or this is showing good momentum and we might camp out here for a while. When we look at the 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE, we're still above zero. So this is suggesting we're seeing some improvement in the broader market. When we look at our long-term high minus lows studies, we're still getting above zero here. And I'm sorry I have to keep clearing my throat. I've been talking all day. Then we're turning back up more with the moving average here as the indicator is still above zero. To your treasury yield, are we going to spike up and start to come down? Will that give support to the S&P? The S&P to utilities ratio has been chopping around a lot lately, but overall it's been going up, which often gives good support to the S&P. The staples to S&P 500 ratio has been going down, which typically gives support to the S&P, even though it ticked up slightly on Friday. And here's where we're seeing another extreme reading with the 19-day exponential moving average of the advanced decline ratio of the S&P 500. We're starting to get a little bit extreme based on price, but we've not climbed above this level based on volume. Tom Belly's research, we're coming into the latter part of November where we typically see positive results. So what's our outlook for Monday? We're still dealing with earnings season. We're still keeping an eye on all the geopolitical events, specifically Israel. Our technicals, I haven't changed this. It's still positive and we're overbought. Is there weakness developing? Again, I've tried to explain both sides of that. It's a way that these indicators are calculated or that we are overextended and due for some kind of a pullback. We will get new home sales on Monday, and then we're keeping an eye on the whole list of geopolitical events. Here's the new calendar for the upcoming week. We're going to get the second reading of GDP. This probably won't be a big market mover unless it comes in drastically different than the first one that we received. And then PCE prices, that's a big one, and that'll be on Thursday. And another big one will be the ISM manufacturing on Friday. Looking at November 27th, which is Monday from 2001 to 2021, we are positive across the board for the Dow, S&P, and NASDAQ. We've now gone beyond options expiration week, so we're just finishing out the month of November, where we do see both during a pre-election year and when you take all the years together, the green line, the dashed green line, and the solid green line do show some improvement for the 18th trading day of the month, which is what we will be on in Monday's session. We're also coming into the latter part of November where we typically see positive seasonality. Also, the black area here tends to be positive, and this other area tends to show positive seasonality as well. And this other chart also shows positive seasonality. But Carson, they're showing a little bit of weakness in the latter part of November to the early part of December before they see more strength going into the end of the year. When we look at the NASDAQ for the Stock Traders Almanac, we're now coming into the latter part of November where sometimes we see good seasonality, and we're seeing that same good seasonality for the S&P 500. So our scenarios, we really can't go with the down one unless you are super, super aggressive and you think, yes, these indicators are falling apart. The market's going to go through the floor. I'm going to short the market. Okay, fine. But we don't have any real, what am I trying to say? Intelligence. There's really no proof of that right now. We're just seeing some weakness that could be developing, but it may not be developing. We're also seeing an awful lot of strength right now, but we are overbought. But if anything, we still go with the up scenario. That's what our charts are telling us. We're not going with the sideways trend right now because we are in a trending environment. So we look at the warning signs, and I had to switch this one back over to this chart. The 5 period's going back up, and that's negative. The risk on posture, it would be nice if that would really kick into gear and start to go higher, but it's just not. The Russell, the small caps, and the mid caps are working off of recent death crosses. Then on the positive side, longer term, the 253 period equity put call ratio is starting to roll over and come down. The daily special K chart is positive. The weekly chart, and I'll go over that in the weekly video, continues to be negative. On a momentum basis, the S&P and NASDAQ are still positive. The parabolic SAR and the vortex are still positive, even though the vortex is looking kind of extreme. The bullish percent index for the S&P is above 50 and climbing. That's positive. Small and mid cap growth, even though it's chopping sideways, continues to be positive. And the financial sector has generated a golden cross after briefly having a death cross. The longer term new high, new low study that we do is positive. We're above zero again. So our conclusion, and you can say this across all different time frames, we're positive, we're overextended. Is there weakness developing? Short, intermediate term, the same thing. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I will be preparing the weekly video, the intermarket analysis video, and the deep dive video. They might be delayed a little bit because I'm well back in the hours that I usually allocate to do these things. So bear with me and I'll get those posted as soon as I can. Have a great weekend, and I will talk to you in the next video.